How did we get here? All right, let's start back in January of 2020. Those of you guys that were with my channel at the point, we're a much smaller channel. We started liquidating portfolio stuff as we started seeing COVID ravage the EU. We were paying attention to it at China. It moved to the EU, started going on in Italy. Then we saw that there was a very good chance it was coming to the United States. A lot of people sold, a lot of people liquidated, a lot of people hedged their position. Market priced in what the expectations of COVID's impact on the economy over the next several years were going to be based on what experts were saying. We dropped 25% in a matter of 3 weeks. Now, we did find a bottom. The first few days of that saw massive blocks of sells. Now, let me tell you something. Those massive blocks of sells were not your 401k. Your manager of your money was not selling it for you. That was not you. That was big money getting the fuck out when they saw it was coming. Congress sold here. BlackRock sold here. Citadel here. Okay? Then we saw it fall. Then the market started to bounce a little bit at the bottom as we started to get an idea of how bad this was going to be. We started seeing what was happening in Asia and in Europe and realizing what was happening there was a microcosm of what was going to happen here. Immediately, we saw 6 million people file jobless claims in a month. A couple months prior to that, those were some big numbers, 200,000. All of a sudden, people realized this isn't just a pandemic. This is going to be an economic killer. This is going to destroy the economy. This is going to halt our GDP. Now, what is a recession? Technically, a recession is 2 quarters in a row of flat or reversal on GDP. They saw this was coming. A couple months later, this quarter, we saw anywhere from, depending on how you priced it or looked at it, 20 to 64% decrease in quarter GDP. This had to end. So, if 6 million people in 1 month are going on unemployment or losing their jobs, that means that this isn't over. Pricing that in is what, and looking at that is what the global banks and the Federal Reserve and everybody looks at. So they're saying, okay, if this goes down by 50%, even 4 months in a row, we're looking at 10 to 20 million people out of work. All those people out of work, they're not making money. If they're not making money, they're not spending money. If they're not spending money, they're not growing other businesses. And if those businesses aren't growing, then they're not hiring people and they're not buying things from manufacturers who then are getting imports and exports and the whole 9 yards. So that's when we had to do money printer go burr. So we start cutting rates. We cut rates because we want money to be cheaper and we want more people to borrow money. Because technically, if they borrow money, they're spending that money. If they're spending that money, it's causing economic growth, right? If you go out and buy a house, somebody's got to build that house. Imports got to come there. Trains got to do this. Electricians got to have jobs. If you go out and buy, stuff at Abercrombie and Fitch, somebody's got to work there. Somebody's got to produce that. There's a lot there. So it keeps the economy going. So you cut rates and you give money to people to spend while they're out of work. So we enhance unemployment benefits and we give stimulus checks. So while we're waiting for this to subside, here's some money, go spend it. The government does that to grow the economy the same way your parents used to give you $5 to go to the store and buy something so they could get freaky once a month. All right, so all these jobs, we're spending money. We're starting to realize, wait a second, this pandemic is going to last longer than we thought. We need to stop people from going out of work. We need people to stop going out of work. We need to try to hold as much employment as possible because the longer people are out of employment, the harder it is to get them back into employment. So that's when we started going with the PPP. Government passes an emergency order, the payroll protection plan, right? We're going to give this money to employers and say, hey, listen, this is a loan that you don't have to pay back as long as you keep your people on payroll. And we thought that was going to work. But then 2 things happened. Number 1, the money was going to people who didn't need it. Ruth's Steakhouse, Shake Shack, the Los Angeles Lakers, Mr. Beast, FaZe Clan. They all took advantage of it, and businesses that needed it didn't get it. And number 2, people started realizing, why would I stay on payroll at my job at a restaurant making $3 per hour without any customers to pay me tips, or at my job at McDonald's making $7 an hour getting shit on, when I could stay at home, collect unemployment with federal enhanced unemployment, and make it the equivalent of $50,000 per year or about $25 per hour. That's not lazy, that's smart. So then more people started leaving the workforce. But that was behind the scenes. We're back to the market. Why did the market start V-shaping? Well, that goes back to the money printer and interest rates. Everyone has money. Everyone can get cheap money. So what did that do? That started inflating equities. Equities were cheap. We just had a crash. Now there's cheap money. Also, all those people, 6 million plus 3 million plus 3 million plus 3, they had money that they never had before. So what did we see? Personal income and savings at all-time high. They had money. And the market crashed and everybody was talking about how the market was super cheap. So now equities continue to go up. And now there's all this money, and where are you going to put it? 3 places: stocks, crypto, and real estate. So what did all 3 of them do? Nobody was buying stuff because it was a good company or because of good long-term or whatever like that. They were trying to make money. They were trying to protect or do something with this money. So they start going up, 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 up. $400 billion in retail money entered the market. And so we saw more money flow in. And then the housing market started going up because remember what the Fed did? They dropped those interest rates. I may be part of the problem because I kept yelling at you guys in 2020 when the 30-year dropped down to like 1.5. I was like, go refinance your house. Now's the time to buy a house. And houses were at normal prices, but loans were super cheap. So everybody rushed out to buy houses, which jacked the prices up. Then FOMO started happening and people wanted to get in. So that jacked the prices up more. But no inventory came on the market because of the housing moratorium and the eviction freeze. And then people who were no longer at work or were working from home were stuck listening to their significant other bitch at them or do stupid shit, and their kids screaming all day or home from school, and said, fuck this, I need a bigger house. We're getting out of this city. So now we have a flood of people going into the suburbs and jacking prices up again. And then you had big corporations coming in. There's a pattern here. So everything started getting inflated. People were putting their money stuff and things were changing. Speculative stocks especially started running, and then the FOMO kicked in and everybody was trying to buy these cheap stocks because they saw their friend get rich, or Kathy Wood's ARK, or somebody got rich on this and that and that and that. So we ended up seeing more and more. We just saw this immovable just bubble just starting to go like crazy. Let's not even get into supply chains. I'm talking about just how do we get here at this moment. Then it seemed like we might cool off for a little bit. Then Gamestop happened. And every fucking retail trader out there who didn't know about the stock market or wasn't having their money in the market is now throwing their money in the market because they wanted to have the next Doge, the next GME, the next AMC. And they all started going. Bed Bath & Beyond, Lumber Liquidators, BlackBerry, Nokia, Express, Zom, and on and on and on. And some good ones got caught up in it too. So this continued. And you might be saying to yourself, but Stocky, why didn't it stop? Why did it keep going? Well, very simple. People weren't going back to work. And the Fed said they can't start tapering or raising rates until we get employment back. So they kept pushing off the idea of tapering, pushing off the idea of raising interest rates. So people are like, well, fuck, more time for more free money. That means more people are going to keep coming to the market. Buy, 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 buy. All the while, the bubbles keep getting bigger. Then something interesting happened. Remember what we talked about a year ago? When we talked about inflation and employment? Now all of a sudden, all that money printing, coupled with supply chains and coupled with people having more money, now we're getting a problem. If we don't cut interest rates, inflation will get out of hand. It's transitory for now. That gave enough confidence to keep buying. Inflation starts skyrocketing. At the same time, though, we have a little fun fact. Not so fun fact. Jobless claims start dipping. Unemployment starts going down. Well, yay, we're saved, right? Everybody who's out of job is demanding more benefits and pay. Competition heats up, labor market's high. Everybody starts offering more compensation. People go back to work. We're saved, right? Well, jobless claims are coming in, meaning not many people are leaving. 4+ million people per month are walking away from their jobs. But they're not counted in unemployment or jobless claims because they're not actively seeking for work. Everyone's leaving the workforce. But we're showing that employment's getting better. And we're getting to a point where inflation is getting at the levels it hasn't been since 1982. So between that and the fact that they're saying the economic recovery has happened and that we're going to be good down the long run, we're going to start raising interest rates. Well, guess what? There's the end of your cheap free money. As big boy investors, they look at it and say, and this already happened, the bubble, this is the FANG, right? And Fat Mag, whatever you want to call it now. The spec bubble did this and burst the whole time. Retail traders know because they were the ones that got caught bag holding all the way down. FANG holding up, keeping the market from actually falling out of the sky. But when you start seeing the fact that cheap money and free money is going to start going away, the Fed's going to clear its balance sheet. They're going to taper asset purchases. That means money, unemployment money is going to stop going out there. You've got New York, New Jersey, Texas, the first that are going to stop giving rental and housing assistance. Now, all of a sudden, that whole thing of everyone's going to keep getting money and putting it into equities because they don't have anywhere else to put their cash, right? Where are you going to put your cash? You don't leave it in cash. Where are you going to put it? Housing market's at the top. Crypto's crazy. Commodities are all over the place. So everybody put it in equities. And now that that's over, the big money, smart money, long money is saying, okay, this little run looks like it's coming to an end. Let's reposition. Let's move from stuff that's run with inflation and free money on the equity side and move it into divvies. Let's move it into commodities. Let's move it into whatever. Now it's all about how big and how often are those interest rate rises going to happen. Some people are expecting 3 this year. Some people are expecting 5. Some people are saying it's going to be a total of 1 basis point. Some people are going to say it's 1.5. Wednesday next week is a big day because that's when the FOMC meeting minutes for the last report comes out and Powell talks. And most people are thinking that March is the beginning of the of when the rates are going to go up. Now, nothing what I'm telling you here is the exact reason why the market is selling off. Okay, there's a lot of reasons. I can't speak for why people sell. I don't know why BlackRock or Warren Buffett or some asshole in this chat or me or whatever. I don't know. And anybody who tries to tell you they know exactly why it's happening is full of shit. But this is what I'm seeing from my aspect and what I'm getting from the information, how I'm looking at it. The question for me is where is the bottom? And do we actually go back bull territory or do we kind of flatline for a year as everybody's kind of sitting around and waiting? Where does employment go? Do we have another supply chain disruption? And most importantly, eventually the moratorium and eviction freeze is going to end and rental assistance is going to end. And what happens with the housing prices? We already know that your student loan's not getting canceled. That was bullshit, okay? That bubble is here to stay. Credit card bubble's here to stay. The one stat of all of these that concerns me the most from the economy standpoint, remember a while back when we said savings was at an all-time high? We're back to where we were. That's my concern. Not just for the market, but for the economy. And the 4 million people a month who just left the workforce, they're going to have to come back eventually. What workforce are they going to look at? Work from home is going to change things. Do I think the market and the economies are going to crash? No, it's all a facade, guys. There's no bank out there that has like, this is how many dollars you have. And if you have more, we crash. If you have less, we crash. No, but I think we're moving to, if the middle class is here, whatever we call the middle class, I feel like this is the next step where we're just going to see that gap get more. And inflation is not going to go away. It may not stay at the same trajectory, but it's not going to go away.